Katie, let me start with you. It feels like a sort of upside down world. Tech had been up forever. Now it's way down this week. In the meantime, we're seeing things like energy and financials really move up. Is this something for the future?
Well, I wouldn't say necessarily that the world is going to stay upside down forever, but I do think that there are some really visible reasons why we're seeing this rotation trade. And David, some of them really have legs. So if we break it down, clearly the macro story has become really strong. So we have global growth expectations increasing here in the U.S. Obviously, we're expecting a big second half of 2021 and into 2022. So fundamentals there look quite strong, and these fundamentals tend to raise all boats, but some boats are a little more buoyant than others, and the value trade has a little bit more beta to the higher growth outlook. We also have a little bit more inflation, which tends to be good for sectors that tend to be in the value area, like energy, as you referenced. Banks, for example, are enjoying the steeper yield curve. But then I think there's a real fundamental tailwind here as well, as we're actually expecting the growth in earnings for value companies to outgrow growth companies in 2021 and 2022. And then you layer on top of that the relative valuation between value and growth, where we see value still selling, even though there's been a rebound, still selling at a pretty steep discount to their growth counterparts. So it's kind of the stars are aligned right now for this rotation trade into value. But I guess I would end by saying, we don't want to ignore our good growth stocks. Clearly, there's secular tailwinds that are very, very strong there. These are cash flow generators, behemoths. So for us, when we think about the rotation trade and the growth versus value, it's not necessarily an either or, but probably a both and.
So, Laura, one of the things that's driving a lot of things right now in the markets is that 10-year yield, which spiked up last week. People said it might be technical. This week, it's pretty clear it's not technical. It's up over 1.5% now. And the question, I guess, on many people's minds is what's driving that? Is that fear of inflation, or is that simply we think everything's coming back to normal, more or less?
Well, first of all, let me say that as a former, chair of the Council of Economic Advisors and looking at all forecasts all the time, the greatest area of uncertainty in any forecast is really the forecast of interest rates. So let's just start there. And the profession has not been great at timing either direction or at amount. So I do think that what is happening to the 10-year rate right now reflects a sense that the economy's recovery is strong, solid, will continue, that it will pick up pace at the end of this year, and that there will be, as a consequence of that, some uptick in inflation. There is a debate about whether that will be transient or permanent. Chairman Powell has said strongly he believes it will be transient. But nonetheless, if you look at inflation expectations indicators, which I think in this world with a flat Phillips curve in the last 10 years, the best sort of predictor of what's going to happen to inflation probably is inflation expectations. Sure, they're rising. So you sort of see a 10-year rate of maybe 2.5% inflation. You see a 5-year rate of maybe slightly above that. The point is, yes, I think the driver here is an expectation of the economy's recovery being strong, picking up pace, that driving up to some extent the rate of inflation, and that is what is being reflected in long-term interest rates right now. However, look at those numbers. If a inflation expectation of 2.2%, 2.5%, and is not an expectation which leads one to worry. If you take the Fed, and I do, at its word that it would like to see us in a long-term situation of a 2% inflation rate, and that they would be willing for some time to allow the rate to move above that because we've been so far below it. Let the economy recover, let the rate move up a bit, and we will continue. And they said a very strong signal to the bond market this week. We're not changing our policy. We are not changing our policy. This is our policy. Our policy is to stay at the near zero short-term rate we are at, to stay with our quantitative easing policy now, because we believe there's still a lot of room and need for monetary with fiscal policy support to get to maximum employment.
So, Laura, let me do something that we do in media, which is totally unfair, which is ask you a question, and I need a short answer, even though there is no short answer, which is,
Oh, no.
Is it inevitable, Laura, that we're going to have a temper tantrum sooner or later? I'll ask the same question to Katie.
Well, I think I do not know the answer to that question because I would like a technical definition of what you mean by temper tantrum. I mean, I guess I would say the following. What Powell has said is he's not surprised that interest rates that he's seen this movement in the bond market. What he is, the thing that he will have to worry about, pay attention to, is does it become disorderly? He has to worry about the underlying financial market conditions. He does not see any evidence of that right now. So I think I would say I would rather pay attention to underlying financial market conditions, see if they become disorderly, another term we do not have a technical definition for, by the way, and then make adjustments if necessary. But I really want to go back to my first point again, which is if we define temper tantrum or disorderly in terms of just a movement at a particular interest rate, a 10-year rate, boy, that is something that our forecasts find really hard to predict.